Good morning, everyone. I'm Audrey Boissonou with my co-host Kevin Casey, and we are Mortgage Pros 411. Today, we are joined by Tracey King, who is the COO of Partners Credit. Good morning, Tracey. How are you?
Good morning. Great. Glad to be here again.
Oh, God, we love having you here. Sometimes when you have somebody who is wonderful and smart and consistent, it just makes this so much easier. You know what I mean?
Just like that. Now everything's just going to go downhill.
Yeah, the
It's
bar is
really-
set.
It's all in the, okay.
Yeah.
Well, we know that's not going to be the case. However, let's take a moment and talk about why the market has tanked this morning. CPI came out, and even though it was better than it was before, headline went from 3.4 to 3.1. Core just stayed the same, and they expected it to go down a tenth. So it was hotter than expectations. Everyone, including, some of the feds, they thought it was going to be better, and it wasn't. So they were disappointed. Everyone's sad, and to celebrate their sadness, they're selling off bonds. So anyway, it is a rough day, but this is how it goes, kids. I mean, it is always a crooked trajectory in a direction that we're going. So with that being said, we will have mortgage apps tomorrow, like we do on every Wednesday. What is wrong with me today? Every Wednesday we have mortgage applications. That will be tomorrow. Thursday we have retail sales. So we'll see what the consumer is up to. Then also NAHB builder confidence, see what they're feeling. Friday we have housing starts and building permits and PPI. That's wholesale inflation, producer price index. So, and that goes into core PCE, which is what the Fed really watches. So Friday's a big deal. Every day seems to be a big deal, but we're just on this little roller coaster, and it is what it is, right? So I think it's interesting though.
The only one we can control is loan applications.
Well, okay, so exactly. So, well, we can control our own loan applications. And Kevin, how are you feeling about business right now?
It's been great so far, 2024. It was pretty consistent. Although yesterday was kind of an doldrums. I think everyone was depressed. Well, at least half the country was depressed about the results of the Super Bowl. So I think that's why it was slow yesterday.
Well, I think those of us in San Francisco were depressed. I think the rest of the Chiefs people were happy, and then everyone else didn't give a crap. I mean, my phone rang off the hook yesterday, and it was busy, but it was funny because I saw this thing online this morning or yesterday, or I don't know, sometime in the last, it must have been this morning. And a guy named David posted, do we have any insight as to why shelter costs came in at 0.6 instead of the expected 0.4? So shelter's still messing up the inflation numbers. And Armando responded, the alien Fibonacci broke through resistance during an election year where the feds have had their heads up there, ... Who knows? Does anyone understand any of this? Just lock them if you got them. I've given up on gambling. And I feel that way. I'm like, listen, we are going to have business this year, regardless of what is going on with the rates, because very little of what I'm doing right now is Fannie, Freddie, A paper, jumbo. It's all funky cross collateralizations, investment. I've got a bunch of first-time buyers, or not just first-time buyers, but buyers. I have move-up buyers, people who are selling, like all getting ramped up and in the queue. So there's
But then getting
everything
them
out
in
there.
the contract and then keeping them in contract. There's two.
But nobody's calling me and going, okay, I have to know the rates first. Nobody's saying that.
Oh, I'm getting it.
You do?
Yeah, I still get it. I'm like,
Well, that means you're not being firm enough.
well, I've come to work my inner Audrey and say that's the stupidest friggin' question in the world.
Tracey, a few months ago, I was at this thing. It was I don't know, we had a booth somewhere, and these people, everyone kept coming up to me going, what is the rate? And I literally looked at this guy and I said, that is the dumbest question I've heard today. I'm like, because it doesn't matter what the rate is. Can you afford the payment? Does your property cash flow? Is it a good investment? Is it going to appreciate over time? Come on, people. We have to shift the narrative.
Well, so
you do have to, I was about to say, but that's what everybody knows what to ask. That's the only question they know to ask. So shifting the narrative 100%, but that tells you the mind frame of the borrower, find out what the rate is. Okay.
Right.
There's so
right,
much.
Because that's all that matters. Like whether somebody has a good appraisal company that they work with, that your appraisal won't come in $400,000 under the purchase price. That doesn't matter. I mean, do you have any other option other than Fannie Freddie A paper? Oh, you don't? Oh, well, I won't ask about that because, whatever. I mean, come on. We have to educate the public because again, and I yell at the regulators about this. I do it. No, I don't do it nicely. I'm the same way. I'm like, listen, they're always like shop, shop, shop. And I'm like, okay,
Yeah.
that person just worked on their credit for 4 years with someone. And you're telling them that at the end of that 4 years of that person who helped them not getting paid, just to be clear, they should go shop for the lowest eighth. Come on. Makes me cranky.
That's
And
the argument for triggers. That's
Yeah.
what they say. The argument about triggers is that it's
That's a good lead in, the
Yeah.
argument triggers. Unfortunately, we lost Trey. Oh, there she goes. We lost you for
there
a
she
second.
is. Okay. So interesting when we're talking about how the consumer is feeling, actually, because the consumers are using the buy now, pay later option big time right now. And we have, what do we have on Thursday? We have retail sales. So we'll see, are the consumers buying? And the market always really rallies when the consumer is really out there spending money. What is it, Kevin? Like 70% of the economy is consumer
Sure.
spending, some
Yeah.
humongous number.
That's a good thing.
Okay, right. Except when they're doing it this way, which is 34% of adults use buy now, pay later in 2023, up from 2022. So 85% are paying over time, 15% were paying in 4 installments over an 8-week period. But what it's doing is those payments are over the next year, presumably. Some of them are over 8 weeks, but some are over the next year. And that's going to impact what they can afford to pay in the future. So we have to keep an eye on that because it will impact consumer spending in the future. It will impact the economy, et cetera, et cetera. So anyway,
Before we move on to the next topic, I want to just touch base on what the rate is because I had a really interesting exercise I did for a client where there was the question of what's the rate. And when I did the analysis for them, they were moving from a four bedroom, 3-bath to a 5-bedroom, 4-bath. And they were trying to keep their payments about the same, keep the loan amount the same.
Oh, wow.
And it turned out that even though they were going from a 3-point-something interest rate to a 6.75 interest rate, the payment was only $200 difference per month. And it was like, that's no brainer. You want to buy the extra larger house for $200 more a month? Take it. Let's go.
How did that, because they were putting so much down?
Yeah, it was a small loan amount, so that was part of it. As they're carrying their equity over from one place to the other.
Yeah.
So that was part of it. But the other thing is they're resetting the term of their loan from, they had from a while ago to now it's going out longer. So that was part of it also. So I was surprised how close it was.
Yeah. Well, it's just a great reminder. We always have to do the math. And really the bigger question should be, what will my utility bill be in that bigger house? Because that's a huge one, right?
Mm-hmm. Actually, it was the HOA going up by $200 and the taxes went up by another $200 for more of the driver on the decision. But in the end, they decided to go ahead.
Well, and another thing too, as people are starting to sell their houses and talking about moving, like I've had clients do in the last few weeks, if they're over 55 in the state of California, they can take their tax base with them. And so we all need to be educated on how we do that. And on that note, I actually have a title guy coming to next week to talk to us about all that's going on in the title escrow industry, which is crazyville right now. So anyway, yeah, it's like we just have to make sure we've got our part covered and that we are giving them clues on how they can at least save a little bit if they are deciding to make a move.
So while we have Tracey, so let's get back to the topic of hand of trigger leads as you decide.
Okay, hang on a second. I just want to say that Tracey gets the award for the guest who stays engaged the best while we're babbling about other things. Like, I mean, some people you could literally watch their eyes glaze over. I start talking numbers half the time. Kevin's checked out, and the guests are like, da, da, da. It's not about me right now. Okay. I don't have anything. I'm not interested in this. And you, my dear, nope, you just sit there and you just stay engaged. I love it.
Half of it is fear that you're going to ask me a question about all these acronyms that I have no idea what they mean, maybe. So I think it's the time that I actually turn away. I need to keep engaged just enough so I can say something witty back, but
Well,
That's as
that
far
is fair
as I
in that you never know what I'm going to throw at you, right?
go.
So,
This is true
I
too.
never know.
But one of my
That's for
favorite things
sure.
about you.
well, let me tell you, it doesn't make everyone happy. Some people don't like it, but whatever. All
We're
right.
not
So,
every woman.
right. So to Kevin's point, let's talk about trigger leads right now. Does that hit your radar at all in your capacity as COO of partners? Is that
All the
something you
time.
guys, it does. Okay, talk to us about what
Well,
you're
I mean, it's just a
hearing.
lot of misinformation, right? And it goes back to the narrative that we talk to our borrowers about. So, all of this year, especially where there's fewer loans out there, there's more competition to grab that loan. People were buying more trigger leads than before, and so borrowers are being bombarded, and they blame.
Lost her again.
Yes, just give her a minute. She'll be back.
You sure?
She looks really pretty when she's like just, frozen like that. Not everyone looks
Could be
that good.
worse. Sometimes you're like,
Exactly. It happens
Am
all the
I
time.
frozen?
you
You were
dropped out there
frozen. You were
again.
frozen. But now we were
Yeah.
just saying how good you look when you're frozen.
Oh,
So
well, thanks. I'll try to move somewhere in my house, maybe that's not, but so basically the LO is feeling the brunt of it, where
Yep.
they're being blamed for everything. So then that
Mhm.
comes back to us of what can we do to get in front of this. At first we started talking to people about opting out,
Right.
how far you can go with that. And then, we talked about the pre-quals and how far you can go with that. Then their prices increased. Now what? Trying to get different people on board to go to legislation to get bills passed. There's been different varieties of bills that have been presented of how this looks. And so it looks like there's yet another version of this that's out there now that people should contact their reps about to kind of push forward. But
So just
ultimately,
let me just stop right there, just to be clear. It is the same exact bill, but now it is co-sponsored by Ricky Torres, the Democrat, and then the Republican that
yeah,
had dropped it for NBA. So NAM had dropped it for with Ricky Torres, and at that point they couldn't find a Republican to save their lives. Then NBA dropped one with, I don't know which
Republican?
which Republican, thank you. Appreciate it. Anyway, so but now finally, hello, a zillion years later, they combine forces. So it is really important that we as LOs are out there supporting these, because we really want to make sure that again, this is not to stop servicers from contacting their people, which
yep.
was a big stumbling block. Originally that was the pushback is, hey, we own this loan and we want to be able to keep in touch with people. Well, they can still do that with this bill. It's to stop the 96 bazillion robocalls and liars. And there's so much garbage out there. So
Yeah.
And then there's a push also in California to block them from the state of California if they don't see the Fed doing it.
right. Well, they're talking about it, but nothing's happened there. So
Nothing's happened yet. So
yeah,
but they're leaning.
it's
they have someone who's interested in it. So
right now it's not it's more a dream than happening. But if we could get some, muscle behind that, that'd be great. I think we're at a federal level though, that would address it nationally. And I think that really would be helpful. And again, plan B is okay, state by state, but that's a
yeah,
long
but if California
way to go.
goes, so goes, Arkansas. So
Oh my God. Oh my God. All right.
Well, then it'd be where it's lender based, or is it based on the address of the applicant? And then there have to
Exactly.
be things put in place to actually control that. So it would make sense.
technicalities. Tracy, that's just too complicated. Just keep it simple.
Yeah, well, and nothing is simple in our business, as we know. So, and it was funny and Kevin was asking me, he's like, hey, send me that email. So a bunch of people, including me, got an email not too long ago that was from a company saying, if you're opting out, your clients don't be doing that and it's illegal and blah, 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 right?
And then they sent a follow-up email.
That's right. That's right. So they
So
sent
what's
a
the story behind that one? Do you know?
yeah, I couldn't, he's like, find it. I'm like, I have 18,000 deleted emails in the last 30 days. I couldn't find, I don't know who sent it. So anyway, but
I could find it and I'll send it to you, because we kind of were sitting here just chuckling and waiting. But again, it was giving the argument that other people have given the argument for, of why trigger leads were invented in the first place, is that it's giving the borrower options. And that's basically what they were saying, is, make it a competitive market. But I think that what you both have said is, the narrative to the borrower, what is a rate? So all they're getting bombarded by are different lenders saying, we've got a better rate for you. And it's a bait and switch, right?
Yep.
Because they're not taking into consideration everything else. They just see someone, you're giving them 6.75 and someone's giving them 6.5. But that's just the first part of the story, as we all know. So,
well, and by the way, wasn't the company that was sending this selling trigger leads? Isn't that, do you remember?
Yeah, I'm gonna look it up while we're talking.
So anyway, I'm sure
I would love to see that.
I'm sure a bunch of our listeners got it too. It wasn't just me, because I saw people talking about it online. And so
it's funny that I didn't get this, because I've been the opt-out priest.
Yeah, he's the worst. He's the worst offender of them all. I mean, good grief. Anyway, but the bottom line is, there is opposition, and for a long time, I don't know, we've been talking about trigger leads in Washington, D.C. and for years and years and years and years and years. And the pushback was, oh yeah, you're trying to keep it so the borrowers don't have choices. Baloney. The borrowers are all going online before they do anything else. They have nothing but choices. I mean, Big Brother's listening into every conversation. So then as soon as they mention a mortgage, that's all that's going to pop up in their feed. They have every possible choice. It's just completely confusing. And to the point where, Tracy, we have a buddy, Jason, whose borrower literally went to the hospital after receiving hundreds of responses and had an anxiety attack. The CFPB has examples. We had them on, and they had examples of a situation where there were 96 trigger leads, and they know that these are not, like, these people they're making offers of credit when they don't even know if they can, should, what. It's all illegal, a lot of that. And then a lot of times they'll lie and say, I am, they'll call and pretend to be your assistant, or some other.
Let's say your lender asked me to call me because they turning down your
they can't do it, but I can. And so send me all your information. So the fraud that's going on, in the lies and the misleading, etc., is incredible. So yeah.
I have a quick question for Tracy. So I actively, coach my clients to opt out, and then I log down the date that they tell me they opted out, and then I wait 7 days before I pull their credit. If I need to pull it beforehand, I'll do a pre-screen, which has, does a soft pull. But if I can wait the 7 days, I will. And I haven't heard from any clients getting, deluged with phone calls by doing that. But I'm just curious, is that 7 days a good period of time? Is it?
I mean, they say 3 to 5 business days. Okay. So, that gives you a safety. And, the question is, do you have that time? So that's what everyone's kind of looking at. And then, there's a difference between someone that can then, now there's different types of pre-qual reports, as we've talked about, pre-qual and pre-approval based on whether you can reissue those. There are angsty LOs that need to reissue, like they need to have an answer, and they need to be able to give some kind of response to the borrower in that moment, rather than, here's a firm offer, I guess. So the question is, can you wait? Can you fill that span of time like you do, Kevin, and talk to them about their credit, look at what their options are going to be, tell them what's happening in this process? I think people rush through it because they are so worried. It's almost like, the pre-qual reports are there for that very purpose. You're trying to, start it off at least to get a glimpse of their credit, and then, you have time, get them to opt out. But, you're almost defeating the purpose if you have to pull it right away and lock them in. So it's challenging. And for our customers that we've talked about, is that, you need to have some kind of process around this and put some guardrails around it, or else you're just going to be, it's for naught. you're doing that, then the LO is pulling the hard pull. They're going to get the dings anyway. And now you've doubled the cost of your credit.
Yep. Yeah, I mean, I find it's much better to, just wait if you can, because it saves the client, almost $100 if there's two of them in some
Okay,
cases.
so let's talk about $100 for credit report, shall we?
Yeah.
So credit
Favorite
reports went
topic.
way up in price in January. And for people who were in the first tier when all this was rolled out last year, it was even more painful because we got hit with everything all at once, right? So it went from costing not much for credit report to like $1 zillion at this point, approximately. And so, but it's something we're all dealing with. And I'm seeing conversations online where people are asking borrowers to pay for the credit report up front now, or maybe
Yeah.
they'll hang in there for a month or two and then they're like, they'll say, okay, I did this for a month and my credit report bill was this much money and now we're asking the borrower to pay. What are you hearing or seeing around that topic?
I hear a lot of people talking about it. I haven't really seen people.
Oh, there it goes.
You lost your,
Yeah. There it goes. Okay.
I'm gonna maybe we'll take a tour of my house.
Wait, you know what you gotta do? You gotta freeze on that moment. Wait.
I know that was a good one. Yeah.
All right. Next
So
time I
seeing
stop
people do it
talking,
yet?
I'll move to a next place. But I think that where are we going with this? Oh, fees. That people are scared to do it because I think that they feel because it's a bigger fee. Are you going to charge them for the whole thing? It's a difference when people didn't want to charge them $20. Now it's 50 or 80 or 90, so that's different for a person that potentially is shopping around.
Yeah.
But what you should be aware of is dependent on the type of pre-qual report you do pull, you now can pass along that fee to the borrower in closing. So there is the issue of all the reports that don't go anywhere,
Right.
but down the line, you now can include that as you would the regular credit report. But what I do want to say is, Audrey, you're talking about how you like to beat up GSCs a little bit or, kind of have some battle. No, not like that, but just, banter. What we're really pushing for right now is, part of the reason, well, the majority of the reason that the pre-qual prices went up so much is FICO. That was the
Right.
FICO scores that increased so drastically. Now, the reason why this makes things complicated is that a hard pull is required by the GSEs to secure that loan. What we're pushing for and what we're telling our customers to push for when they're having conversations with Freddie and Fannie is, why does that second pull have to include a score? If you've already had a scoreable credit report pulled, and especially if you're involved in the early assessment program where you can do a firm offer off of that pre-approval, then why does a score have to be there? Why can't we treat it almost like you would an LQI or pre-close report? So right now that's in discussion with the GSEs. So the more voices that when you're having the discussions with them on your weekly calls or how often you have it, this is something that's important to bring up, because if we remove that score on the second report, one, it reduces your risk. Two, it drives down that cost significantly. So these are important. Everyone's like, how do we make it cheaper? How do we make it cheaper? It's not just going to go away. There's no deflation in the credit industry in terms of the pricing. It is going to be us pushing for different methods and what kind of results they're going to need.
So what is your feeling on whether they would accept that idea of not needing
a gray area right now, and they've admitted it to be. So they have said to us that that is under consideration. So they didn't say no.
What's the typical difference between the scores between a pre-qual and a full pull?
Well, there's nothing to difference between the scores. So if you pulled a pre-qual today and a credit report today, like minute after minute, it's the same report. It looks the same. Everything is the same.
Right.
The difference is that credit is fluid. So if you pull a pre-qual and you're giving a firm offer and you're trying to, wait as long as you can to do that hard pull, well, credit's fluid. Their credit might have changed.
Yep.
Their scores may have dropped and now they don't fall into the same loan you were going to offer. But
that's the risk.
That's the same as if, all that matters to you when you pull a pre-close report. So that would be a report with no scores prior to closing, because you're looking for any new derogatory, you're looking for new inquiries, all this stuff. You're still looking for that. But the scores have changed almost indefinitely. They have, because every day when something's reported to the bureaus, that has an impact on your score. So why can't this be treated the same way? It's still a hard pull. It's still giving you that information. Why scores?
Right. Well, and that's okay. So let's talk about this pre-qual versus regular credit report, because
Yeah.
there used to be a big difference in price, and it's changed, right?
It's changed because, well, one, like I said, FICO increased it. And then the other is trended data, which a lot of people may or may not know about, but your regular credit report, your hard pull credit report, has trended data that is submitted to the GSEs in data that you don't see typically on the credit report. So it's always there. It's not supposed to have any negative impact. It's supposed to only help the borrower, because it's giving essentially data to the GSEs that shows not only like their spending history, but their payment history. So it's more comprehensive. It's not, oh, look, they're at a $10 balance this month, or they made a $10 payment last month. Well, they might consistently be doing 400 payments. And it's just supposed to help kind of understand the consumer more. In order to reissue a report through the GSEs, through Fannie, it needs trended data. Freddie was not requiring it for some time for the pre-approval, but now they're going to probably first quarter. So it's another requirement. It's another piece of data that is more expensive. So yeah. Complicated.
So I'm curious about who's reading this and how it's being read and used, the trended data, because it was supposed to be a big deal. And then it came out and it's on the credit reports. No one really pays much attention to it. Is it really being read by the algorithm, I wonder? I mean, because underwriters aren't looking at that. They're not making, DU's not making, I mean, is DU making decisions?
That's what it's supposed to be. It's supposed to be read by it, allegedly. But there's no firm, again, because it doesn't have a negative impact on the borrower. It's not clear to, we're reading this data, we're assessing this data. It will own, that was, I remember when this came out, because that was the first time we had more significant price increase on credit reports with trended data being added.
Right.
And the whole thing was, this is a positive thing for the borrower, it can only improve, but there was no details as to how.
Right. And so we've never heard anything beyond it's, this is so typical. And this is why I'm so skeptical these days of all of these, new things, and why I'm leery of the Vantage idea, just because they say it's going to do something, but there's never any evidence that they offer later that says, look what a difference it made. Look how much this helped people. Look, we put trended data on there. And so sometimes there is this idea that if it's different, new, if it's technology, somehow it must be better. And that is not necessarily the case. And so we need to be more discerning, I think, as consumers, as people advocating for our clients in the industry, where we're pushing back going, wait a minute, prove it, show me, prove it, show. And I drive people crazy because I'm always saying, prove it, show me. I mean, make me understand it. I'm okay with it if I understand that it actually really helps someone.
Yeah, I'm sorry, but having your utility bill on your credit report does not help your mortgage situation, because I have the loan I closed back in September where I stole away from US Bank because they rolled the utility bill into their debts and said, oh no, your ratios are too high, you don't qualify. And when I saw the thing, and I said, well, the first thing I did was I took the utility bill out of the calculation, because it's not one of the things you put into the debt ratio. And sure enough, their ratios are fine. They're in the like 27 back end ratio. Like, why would they tell you had too high debts? And I realized, oh, it was because the utility bill was included in there.
They do the same thing if they see a pet insurance recurring charge on your bank statement. I mean, a lot of those places. And let's talk about the bigger banks right now, because I talked to a buddy of mine who works at one, and their credit reports are $18, and they're absorbing it, and they have not changed. What is that? How can they
Is that a
possibly?
mortgage credit report?
Yes. How are they just absorbing all of that?
They would have to be.
I mean,
Because
that's
like
not,
we
it
know,
doesn't
there's no
exist, does
tiers
it?
now. There's no tiers. So
Right.
everyone's getting it. And I have talked to a couple of our customers that haven't changed the disclosures. They're just like, they feel like they're too competitive right now. And so they're eating that cost, or they're wrapping it up somehow and putting a line item of credit $18, but then they have a processing fee of 1,200. And there might be absorbing some of
So
that.
they're absorbing it into some of their other fees. Wow.
Yeah.
Okay.
I had no problem getting the clients this last week. I did my first one where I had them pay up front. And it was like, yeah, I'm gonna need your credit card information to pull your credit, and boom, they gave it to me. And the problem is they gave me too much information. And it's like, I don't really have all this information.
I am not a fan of taking credit cards, period. I won't do it. Like, I will not do it. I don't want to be responsible for someone's credit card at all. Because if
Yeah.
something goes sideways with anything in their credit, anything, you're going to be included in the conversation of, hey, you had my information. How did somebody else, maybe somebody got it from you? You know what I mean? So I would say that if there is a mechanism where you can have them feed that information directly into a portal that pays for it, fine. But other than that, I'm like, I am pushing back on that. I am not. The same thing. We're not supposed to take people's credit card numbers for their appraisals. So why in the world would we be doing it for credit reports too? So with that being said, I actually am a fan of the idea that this should be something that is paid by the borrower. And I don't think it's a bad thing up front because,
Mm-mm.
all of this
You're
crazy,
locking in your client.
shopping around like a drunken sailor. I mean, you're going to think twice if you're paying $100 a pop, for a credit report, right? And so I think, and we used to do that. I mean, I've been doing this for 5 million years. We used to have people pay up front. I think it's not a terrible thing to go back to that so that they aren't applying it 500 different places. Okay. I know I am using, it's hyperbole central today. I couldn't say a number today that's not ridiculously exaggerated to save my life, but let's just keep going with that, shall we? So,
Done.
okay. So there was, it did make the news that a major retail mortgage bank adopted FICO score 10T for non-conforming loans. Non-conforming loans, to be clear. So not Fannie Freddie, but what do you have? We talked about this briefly and I didn't get any information on it.
I didn't either.
I'm curious. I'm curious as to the why and how does it help? And like, well, yeah, okay. Well, moving right
Well,
along.
someone suggested, anonymous attendee, that some companies are using the trended data, so they have think another tool to sell individuals on what they're purchasing. Is that possible? True? You heard of
Wait,
anything
say
like
that
that?
again.
Well, read in the questions and answers. It's what about companies who use trended data as a marketing tool to send individual emails on things they typically purchase? You heard of this going on?
I don't know how that would work because if your Visa card is saying that, you've made certain payments,
That
that
would be
doesn't
true.
really
Yeah.
give
Yeah, it
you,
doesn't, yeah,
okay,
the
we need
trended
more
data does not
information.
show what you're buying. It does
Yeah.
show if you use your Home Depot card a lot, maybe that might be something that would show up.
Yeah, all it does is it's giving. So right now on a trade line. So a trade line is, your one line of credit for Visa or let's Citibank, whatever. And it gives a snapshot. What was the last payment made? It will give maybe a payment grid to show if it was on time or not. What
Right.
trended data does is it says, okay, so the snapshot, it shows your last payment was 75. It'll also tell you what the month before was 85. The month before was 100. The month before was 200. That's all that it's really doing effectively. So as a marketing, if you wanted to, anyone can have trended data and you can visibly see it on your credit report. If you're a customer of ours, you can hit a link and it'll show you all the trended data. We don't include it because it would probably quadruple the size of your credit report and nobody likes looking at them anyway. So, but in terms of a selling point, I don't think I'm fully following on
Yeah.
how
Yeah,
it would
I don't
go
either.
through.
Now, seeing their credit cards statements, that might help you, but we don't ask for credit card statements.
Yeah.
Right. Well,
Yeah.
unless you're
Although we do see the bank statements, and you can see, you know, how many times they went to Starbucks. And
So, you know, in terms of this lender utilizing the 10T, I think that part of what 10T and Vantage are saying is that it will optimize lending for borrowers previously unable to be scoreable. And
Right. So show me the algorithm that says that, Tracy.
I don't have that.
I would like the data that backs up that statement.
Yeah, I don't know how they can do it until they have people that can approve it. I mean, again, this lender's using them from non-conforming loans. So what my opinion is, and I think it's a lot of people's opinion, is that what we're all going to have to suffer is once this does get to a point where Vantage is given as an option, there's going to be a reminder. We're on FICO 10 right now. FICO 10T is the newer version of FICO that's coming out, and then Vantage. At some point, all three different score models will be on your credit report. And I believe that we are all the guinea pigs of what this will look like. So for a long time, I think the data is all going to be there, the three different scoring models, and we don't do anything with Vantage or 10T. It's just there. And then once they get the data and start seeing what that data looks like, and they can accumulate how they compare to one another and feel solid with that, then I think FICO 10 will drop off, and then we'll be down to like the options. But, you know, do you have to pick one? Do you have to have both? I think for a while you'll have to have both, and then you can pick. But until they know how they're going to weigh against each other, we're
Well, the
just going to
question is
pay for
often,
all of it.
yeah, I mean, who's paying for all that? And it gets
We
passed
are.
to the consumer. It's
We
just,
are, and we have been. Get ready for the, you know, the FICO increases.
yeah,
Potentially this is paying for years ahead of research. So
yeah, great, great. Okay, so we have a few comments. So Andrea said it's their credit, and just like a landlord charges to verify them, they should pay. Plus they get a consumer copy right away too. And she said she gives them the link to authorize and pay themselves. That's what she does. We have another comment that says that they've been doing this in their company. My majority of loan officers at my company have the clients pay. No clients ever say anything about it. For me, I've never had, but I'm going to start to. So I think this is going to be a trend, kids. I really do. We have a question about how to work with your company, Tracy. So we'll make sure that we put your contact information in the YouTube channel, but just briefly, Tracey King, it's T King at Partners.
yep, tking@partnerscredit.com.
There you
Partners.
go. That's her email address. You can email her yourself. And you will be able to personally enjoy the delight that is Tracey King. So anyway, okay, so this roll out by Fannie Freddie, they kept pushing it down the road, and we don't really have any date at this point, correct?
Correct. It just
Okay.
keeps getting pushed, and you know, everyone that I talk to, I think it'll be years.
Okay, so
2036,
I'm sorry,
2036, possibly.
possibly.
okay, so we have a comment from John who says, as a first in-market user of FICO Score 10T, Movement Mortgage and FICO will work together to share early use insights for non-conforming products to help the mortgage industry understand the benefits of the most predictive credit score in the space, which, by the way, Movement was not the company that was publicized that was adopting 10T, just to be clear. So he went on to say FICO originally released 10T in 2020, saying that the new model allowed for lenders to have greater precision in making lending decisions through the incorporation of trended credit bureau data. The word trended is the source of the T in the 10T name. Okay, I did not know that. Thanks, John. So that makes sense. I would like to see, I'd like to see that data, because you know that everyone talks about it, and then yeah, you don't really get to enjoy seeing for yourself that is it real. Before we put an industry through changes like this, because it is huge. So not only does it cost more, but the reason it costs more is you have to have everyone change all of their systems, and no one does it the same. There are a million different iterations of an LOS system or whatever people are using to handle all these things. So I just think they change things sometimes to change things. And I want to know, is it worth it? Is it really worth it?
Here's the one thing that I'll say to contrast that is that we have had FICO 10 for years upon years upon years upon years. So the question is, did we have a lock in of how we should be evaluating data on a borrower that should stay consistent for all time? So the question would be, are there ways to reevaluate, the weight? For instance, we talk about medical collections. Should that have an impact? All of these kind of different things that we're looking at, like looking at how the borrower is actually making payments versus a one-time payment to pay it off because they know they're getting a loan. Is, utilities, whether or not they're, should be included or not. There is an argument that says there should be ways to improve and make tweaks. I think it has been a glacial pace to get here, and now it's too much at once. So I do believe that there should always be a way of evaluating if we are looking at a borrower in a specific way that helps the borrower as it should, because the borrower, is a risk. We need to assess that risk. However, I think that we have evolved in terms of looking at borrowers, looking at credit, understanding it, and going from there.
That is a great point. And you're right. I mean, so yes, to your point, things do need to change. But when they make sweeping changes like this, and they're huge,
I agree with you 100%.
They're costing $1 zillion to the borrowers, $1 zillion, there I go again. And they're promising, oh, it's going to make everything better. Okay, show me. But anyway, it sounds like some of these mortgage companies are aligning with FICO 10T to check it, and maybe that's how we get there partly. So I'll do some further investigation into how does that work? Like, how are they doing that? I'm curious.
Well, for instance, how FICO first came about was, they took a bunch of, I knew one of the engineers that looked at all these credit reports, and they said, okay, let's go back 4 months or whatever many months, and let's figure out what happened this month that could have alerted us that the client was going to make a 30-day late payment on their credit card. And so they had all these predictors of things that, these are like their credit report before, here's the credit report after the 30-day late. What was in common with those credit reports prior to the 30-day late? And that's how they came up with the scoring models. And they were designed to predict a 30-day late on a credit card. And then I'm assuming they did the same thing in the mortgage world, and what predicts a 30-day late on a mortgage late, what predicts a 30-day late on a car.
Okay, fine.
But where I'm going with this is, but then the medical stuff, that was a political decision, not a, oh yeah, having medical collections on your credit report, that was a politics saying, hey, you can't be judging people on if they have medical collections. That wasn't whether or not it predicts the ability to pay your mortgage or not.
Okay, I would say that sounds dandy, except that if we roll back to, the dark ages when we were doing loans at World Savings and we didn't have credit scores, and you had to put down 20%, didn't have to show income, but it was all based on, does it make sense? Those loans performed. Not once they were sold and the margins got wackadoodle. I'm talking about original World Savings.
Yeah. Back when the underwriter would tell you your client has to close all their credit accounts.
Cost of funds, blah, blah, blah. So you could figure out whether someone was going to make their payments or not. And the number of people who had 800 scores during the lead up to the meltdown, who I wouldn't have given my last dime to ever, compared to the person who had a 670 score, who you just knew that in your heart of hearts that they would do anything to make their payment. Like that feeling that I get inside of me, I get this feeling. I don't know if anyone else gets that, but I get this feeling. Are they worthy borrowers? I told more people with 800 scores, don't buy that house. Have you thought about what your payment was going to be, on your PG&E bill? Have you thought maybe you should go pay off your $125,000 in revolving credit debt before you buy a house? That kind of thing, credit card debt. And so they had an 800 score, and then they defaulted all over creation. So I am skeptical. I'm always skeptical. I'm always questioning. Yeah. So
to your point, and I'll just say this, and is that, again, it's looking at how you kind of score someone. So someone that pays off their credit card every month, because they're like, I did this, I'm going to get the
And on the
points, I wanna
first
do it.
of the day, the statement comes out too.
Their score is not going to be as good as the one that keeps a small balance on it. Now,
Right.
how does that show you
Yep.
what they can do?
And
It's a game. And once if there's a game in which you think about this, and we've talked about it before, that I think we've all used a simulator at some point to see how you can improve the score. If you can do that, if you can do something to manipulate the system in 1 month, then that means that that's not truly giving you an accurate version of the borrower, no matter what you say.
Right.
So, I agree. And I'm not saying that those simulators aren't a glorious, wonderful thing where perhaps if we lived in a perfect world, you have a borrower that maybe just, pulled up that credit card a little higher than they have used to. And let's get it back to what you normally have it at. Or, hey, I know you've been saving up. If we use $3,000, let's see what we can do to get these down. But we know they have a tendency to bring those limits up. You're manipulating a system that is supposed to be built to have a secure way to look at that borrower. That's not doing it. That's not doing it.
Well, but the other thing too is if you've got, I had a situation where I had an 80-year-old borrower who used a gas card they'd had for 50 years, literally 50 years. And they used it, went off. They don't usually use it. And somehow they didn't get a bill. And they didn't remember that they'd used that credit card. That one credit late, one time, dropped their scores 100 points. That is ridiculous. I mean, that does not indicate that he's in trouble. It indicates that he didn't get a bill. And that happened once in 50 freaking years. So I am very we really, I think, need to question some of these things. And we just accept so many of these.
Right. But at the same time, if you're not, as a loan officer, you're not serving your client if you don't do a rescore. If you've got a client who's just below the number and qualifying for a loan.
Yeah, Kevin, I'm not saying that those aren't things you should do. And so I'm probably, biting the hand that feeds me by saying it. It's more so that if we're having a discussion over credit in general,
Right.
that's my argument, that it
Yes.
shouldn't be so easily manipulated. That being said, there are ways to improve it, and that can improve the score threshold for your borrower, that can get them to a better rate or better loan, whatever.
Right.
Yes, you should 100% be doing that for your borrower.
Although there are some companies, mortgage companies, that don't allow their loan officers to do those things.
A lot of banks don't.
But they're also, I've also heard on the other side that regulators look at it and say to whoever just said that, if you aren't doing everything possible to make your client's situation when they do their mortgage the best it can be, you're not serving them. So it's conflicting information all over the place. Okay, there's a couple more things I want to get through to you before you run out of time. First of all, I just thought I'd take a deep breath in the middle of all this and tell you something good, which is in January, rate locks had a 36% bounce according to Optimal Blue, which means there were a lot more rate locks. There's a lot more business going on. It definitely is reflected in what Kevin and I are seeing. So I hope everyone is seeing more loans than we were seeing. Even December, it started picking up for me, but definitely the rest of the year. I mean, it's crazy different. So I hope you're seeing that too. But 36% increase is huge for Optimal Blue, right? Okay, back to credit, Tracy. Okay, so I had a question, and I think this is worth talking about. So first of all, let's talk about authorized users and the impact that being an author. Okay, so on both sides of the equation, somebody has an authorized user, is allowed to be an authorized user on someone else's account. What's going on with that account impacts whose credit and to what degree. So you've got the person who's the primary card holder, and they've allowed someone to be an authorized user. So if that account is maxed out, does that hurt the authorized user scores? If there's a late, does that hurt the authorized? Okay, so everything that's going on for the primary user impacts the authorized user.
Correct. That was what I was going to say. So where people say, well, get them as an authorized user on that account, it sounds really great, but you need to remember that it can impact you positively and negatively. Anything that's on that person's card will be on your credit report. So if they bring up the balance, if they have a late, that is going to impact your score. And The other thing is most creditors. So if you're added, Audrey, you've had a Visa since 2010 and we get married. I want to be on it. I is added as an authorized user. Most companies will backtrack it. So on my credit report, it'll show that I have 14 years of credit history.
Right.
Amex typically does not do that. They do it from the day that I started being on your account.
Interesting.
So what you need to know before you become an authorized user is what is the history of the person's card that you've been on? Because if they had a late last year, that will affect you. So it can bring your score down. And you need to be sure that, you know, they're managing that money responsibly and making their payments on time, because yeah, that can come back and get you.
Wow, that's great. Okay, that's good to
So
know.
it's an
for
Amex
sure.
that doesn't give the history, but the others do, correct?
For the
Visa.
most part. But again, it's good to double check. So
Yeah.
it's, for what I've seen, typically the majority backdate it. Amex does not, but always worth a conversation.
So now let's talk about credit utilization, because there's confusion around this too. So let's say somebody has $100,000 in available credit through credit cards, okay?
Okay.
If they have one account that has a $20,000 limit, okay? Is it better to spread the credit usage across a number of credit cards? Because if you max out one credit card, that hurts your credit scores. So it's got 20 grand in debt. Is it okay to have it all on one card? Let's say he's got a great, 0% interest option on that card. So is it okay to have it all on one card? And then he still has a really low credit utilization as far as overall credit goes? Or is it going to hurt him because he's maxed out on one credit card, even though he still has $80,000 in available credit on other credit cards? Does that make sense?
It does make sense, except that it doesn't make sense for the borrower. So
Okay.
it was the former. So you want to spread it out and have low balances on multiple cards versus a high balance on one card.
So it is per card.
Correct.
Per card.
And you want, yeah, you want to be at 10 to 20% of that credit limit. So this is where it's kind of counterintuitive. And I always forget that, who's the finance guy who tells everybody to kind of like pay it off one credit card?
Dave Ramsey.
Dave Ramsey.
And great for, he's made a great business on all of that, but that works for everything except for your credit report. That does not work to your benefit there.
Yeah. Yeah, he's got a few
But
things.
but if you're paying off debts and you're trying to isolate it, it's a lot easier to pick one and just work on that one.
Again, and it's counterintuitive for sure. It's easier that way, because who wants to sit around and figure out, okay, I want to pay this off. I can pay it off this month, but actually let me leave $10 there. And then I have to remember only to make like a $5 payment or add more onto my account. I mean, that makes it more challenging to manage. I know for myself, if I pay off a credit card, I know I paid it off, and then I kind of forget about it until I go shopping again, if you don't have auto pay on or something to that regard. So it's difficult to have, multiple things open, but to have a more diverse, we like a diverse portfolio, that helps you improve your score.
Okay, that's interesting. So we had a follow-up question from someone who said, does it go the other way? Does the authorized user impact the primary? And it would on that one account, right? It's just that one account impacts both the authorized user and the primary cardholder.
Right. So I guess in terms of like, how does it affect them? You just need to think about, if the authorized user is allowed to use your credit card,
Right.
that it goes both ways. So what their expenditures are going to show up on your credit report. But in terms of, we're looking at the weight of those two trade lines on two different reports, they're even. They are weighted exactly the same. It's not like you have a muted version if you're just an authorized user. It is still the same impact. It's a little bit higher risk for both parties because of what the other person is doing with that credit.
Right. Yeah. So, I mean, having someone be on your credit card is no joke. And if you're the primary card holder, you better make sure those payments are being made. But again, if you're the authorized user, same thing. So you really want to have some sort of checks and balances in place. What?
When grandma co-signs on a car loan, that's when the problems are, because the granddaughter or the grandson miss a payment and they mess up the grandmother's credit scores.
Not
Yeah.
always, Mr. Cynical.
Well, the
Although
other thing,
I did run a credit yesterday and the borrower had a payment of almost $1,600 on a vehicle. And I'm like, I couldn't believe my eyes. And then had another vehicle. And so when I was talking to them, I said, is that a real number? Like, because none of it made sense. Like it's a huge percentage of their housing expense. You know what I mean? And so, and then I said, oh, and what about this other car payment? And they're like, I don't have another car. Oh, my son. You know what I
Yeah.
mean? Oh yeah. And by the way, the
Right.
car's
I
just
had that
sitting
the other
there.
day. Pulled
And then
credit, it was
another
5 BMW payments. 5 for a couple. I'm like, why do you guys have 5 car payments? And like, oh yeah, she has this one, it was the other one, and it was 3 kids, and they had co-signed on 3 kids' car loans. Like,
Okay, so I had someone recently who they had 2 car payments and like $145,000 in installment debt, and they had another 65,000 in credit card debt. And I mean, it just went on and on. I'm like, holy guacamole. But it was a single person. And so I said, okay, what's the deal with 2 cars? And they're like, well, one's the Mercedes and one's the Maserati. And I'm like, an older person, I was laughing my head off, except they couldn't afford it. That was the problem, right? They couldn't afford it. They
no,
were
they have to keep that
deep,
image up, Audrey. They
they were
have to
in
keep the image
deep
up.
doo-doo and they good Lord. Okay, so a few things before we run completely out of time. I just wanted to say that Black Knight has said that there is $240,000 average in tappable equity in the US. And the average CLTV for mortgage holders, these are not people who own their houses free and clear, and there are tons of them. The average CLTV for mortgage holders is 46%. People have a lot of equity. Meanwhile, they're, using buy now, pay later, and they have racked up more credit card than we even want to think about. So when you're thinking about how to plan your day and looking at how you speak to your borrowers, et cetera, make sure that in that conversation, there is, you're talking to them about, listen, let's go through your interest rates. If you're paying 18% on your car and 32.99% on that credit card, and you're paying, and these are real numbers that I've seen recently. And so, okay, that 3% might be costing you on your house big time, right? So make sure you're doing the math. I know we say this a lot, but it cannot be overstated. Also, I thought it was interesting that the 715 is the average FICO score in this country for everyone. Have you seen that, Tracy?
I haven't.
And 761 is the average for homeowners. So
Wait, what
to
are the
that
numbers again?
point, 1.7 million are eligible right now with the rates where they are today. And once we get to 6%, 3.8 million more will be eligible to refinance. So just be out there really looking for opportunities to help your borrowers. And because it's really interesting, because some of the other things that I'm seeing is the CEO conference survey came out that the conference board puts out, and Q1 CEO confidence, which by the way, I'm like, wait, it's February. We're still in Q1. So I don't know how they're doing the Q1 report in the middle of February, but whatever. So the CEOs of the companies though are feeling better because of the improving moderated inflation, and they're anticipating the lower rates that are going to come from the Fed. But 23% of them expect to lay off workers, up from 13% last quarter. And 35% expect to expand their workforces versus 38% last quarter. So things are not, like it's really such a mixed bag out there as far as the economy, but the borrowers are getting laid off. They're having a harder time finding jobs. There are more people with second jobs. Those jobs reports are full of second jobs being created, not good full-time jobs. So just know that we have so many opportunities right now, and so much of it is mindset and how we are approaching things. So I know that Kevin and I are just out, we're just beating the bushes, and I think I got 3 loan apps over the weekend. So it takes some time because like one of them I talked to in December and that just poof, I check in every once in a while. So you just have to make sure that we're really out there acting like salespeople and doing our jobs and being proactive, and do not wait for it to fall out of the sky, and get the hell out of your house and go meet people in person, because that's really the way forward. Right, Kevin?
Yeah, maybe.
And I'll go back on what I said earlier. And just to reiterate, I'm all about the simulators. It's also a really great time to work with a borrower that might not be at that 715 or 760 and say, just because you don't have perfect credit, that doesn't mean you can't get there. And you can have the tools available to you that you can look ahead and say, what can I do in a month? What can I do in 3 months, in 6 months, even to a year? That I think a lot of people are missing out on the power of locking someone in by educating them.
So one of the loan apps I got today was from somebody that I spoke to 4 years ago, 5 years ago, and I've stayed in touch with her. Her credit score at that point was in the mid fours. I think she might have said 430 actually. And she's at almost 700 right now. It took time and she had to work at it. But yesterday I was telling her, I'm like, I'm so proud of you. I'm so proud of you. And now she wants to buy a house. I mean,
Yeah.
that's the way forward. And anytime when someone starts saying, "Oh, you're manipulating the credit when you're coaching them on what to do," the whole point is most people don't know what to do.
Yeah.
You're coaching them. You're not manipulating it. And if in fact, okay, if they're just jerking everyone around, okay, that's going to be the one-off. The average person doesn't have a clue. So that's our job, is to help them be the best they can be. And with that, we are out of time. Can you believe it? Tracey, thank you so much for everything. Again, tking@partnerscredit.com if you want to contact Tracey about using their services. And they do have simulators so that you can help your borrowers understand what they could do to make themselves better and improve their.
And make sure you include the partnerscredit.com, not partners.com, correct?
Partnerscredit.com. Yeah.
Yes. All right, kids. Well, have a wonderful week, and we will see you next week. Thank you, Tracey, so much.
Thank you guys.
Appreciate it.
Take care.